Okay, welcome back. Today we're going to talk about Chapter 6. And in this lecture and the next lecture, we're going to cover the two main components of the key value driver formula that managers can focus on in order to increase and create or generate additional value for the firm. Right? So remember the key value driver formula from last chapter, that the four main components there were NOPLAT, return on invested capital, or ROIC, G, which is the growth rate in revenue, or NOPLAT, and WACC, the weighted average cost of capital. So there are four components in that model. And again, you're going to need to use that model on the exam and on the homework. So it's incumbent on you here to memorize that model. I'm not asking a lot there. That's just one model for the whole class. So, but it's really important. So there are four main inputs. It turns out, and we'll talk about all of them in depth, but it turns out that the two ones that generate the most value, and we saw this a little bit when we looked at the growth return matrix, value matrix at the end of Chapter 2's lecture, the two main components that generate value are ROIC, which is return on invested capital, and growth. So we're going to spend the next two chapters talking about those two things in great detail. Specifically, what we're going to focus on is how do we, or how do managers, depending on what role we're in, are we in the role of someone advising the management team, or are we in the role of the management team themselves? But regardless, how does the management team undertake strategies that focus on increasing return? Which ones are successful, which ones aren't successful? We have some empirical data, historical empirical data at the end of this lecture that we're going to cover that demonstrates which ones end up being successful, how much value they actually create. And so, of course, this isn't an exhaustive list. We're just going to talk about the big strategies, the ones that have been successful, the ones that a McKinsey consultant would recommend, and for a general firm. And then, of course, if you're doing something specific or looking at a strange or unusual firm, you might come up with some different strategies, but that's sort of outside the scope of this class. Okay. So we're focused here on return, and there are two things that we're really going to have to talk about when we talk about strategies to increase value. Okay. So the first one is, why is ROIC so important? In other words, what does ROI do, or what does return do to actually generate value? Okay, so any strategy that tries to create value by increasing return, we want to understand the mechanism behind how that works. So let's start with a real simple example, and then basically the rest of the lecture we're going to go through and give lots of different examples and talk about lots of different strategies. Okay, so this first example is actually, to me, it's pretty interesting. And it arises way back in '99, which seems like a long time ago, or it doesn't seem like a long time ago, but was 20 years ago, during the dot-com market boom, right? And just before the dot-com market crash. And we want to compare two companies here. The first one is eBay, which I'm sure everybody's heard of. And the market capitalization, so the value in the market of all of the shares of eBay, was $23 billion in 1999. And there's another company called Webvan, right? And you probably never heard of Webvan because it doesn't exist anymore. But it was another high-flying internet startup. It had a market capitalization, so it was worth about $8 billion in the market. So that's a pretty sizable firm. Not as big as eBay, but both of them are pretty sizable. Now, the question is, both of these are high-flying internet startups. They didn't have really any financial history to show. Neither one of them was making any profit, which was true for a lot of these internet startups during the dot-com boom. So why did investors value eBay so much higher than Webvan? Right? Again, neither one was making a profit. They were both losing tons of money. They were both internet startups. There was a lot of similarities behind what they were attempting to do. The question is, why was one worth more than the other? And the answer is return, right? The difference between these two companies was based on their capital intensity and their strategies. So Webvan was a company that was way ahead of its time. They were trying to be an online grocery delivery business. Of course, if they had started 2 years ago, they'd probably be wildly successful at this point. but they started 20 years ago and people just weren't ready for that. People weren't ready to order their groceries online. The infrastructure wasn't in place. And beyond that, now that we've said infrastructure, we hint at one of the major problems with a company like Webvan, which is that they require an enormous investment in capital, right? Their infrastructure required to deliver groceries is enormous. Right? Whereas eBay is basically just a flea market, online flea market. You go on there, you list the crap that you want to sell, you look at everybody else's crap that they're trying to sell, and you buy or sell, right? Originally, it was a bidding platform, so you were making bids on whether you wanted it or not. Now, of course, they let you buy things outright, and it acts more like a traditional retailer. But they had very, very little necessary capital investment because all they were doing was making a platform, building a place where someone could go and say, I want to sell this. But they weren't facilitating the sale or delivering the sale. They weren't doing any of that, at least at first, right? And so the difference between these two companies is what we call scalability or economies of scale. Right? Webvan had terrible economies to scale. Meaning, let's say you are starting Webvan in your garage in Palo Alto. You're like, this is a great idea. People are going to want to have their groceries delivered. Grocery shopping sucks. It takes a lot of time. It's going to be so much easier, and people are just going to jump all over this thing, right? But when you raise the money to start the business, you build your nice website, you connect to this grocery store, you list all their products, people go on there. What's the main thing that you need to actually make this business run? Well, you've got to have delivery, you've got to have storage, you've got to have people go to the grocery store, do the shopping, store it in a truck, and then take it to the house and drop it off. And of course, it's not cost effective to do that for one person. So you're going to have a big truck, and that means you probably need a big refrigerated truck. Then you do the shopping for 20, 30 different people, pack the truck full, then spend all day driving around delivering all that food. And of course, it's got to be refrigerated or it spoils, right? So economies to scale means that adding more customers, it is cheaper and more profitable for the company. So the bigger you get, the more profit you earn. But think about how that works for Webvan. If they've got one refrigerated truck and they've got a couple of delivery drivers, they might max out at, say, 50, 60 homes for that one team. Right? So if they have 2 customers, then they have some economies to scale. Growing to 60 is cheaper for them. They would rather have the truck full and the deliveries going all out because that means they're utilizing their capital, all of their investment efficiently. But once they get to 60, their economies to scale stop because if they add one more customer, 61, all of a sudden they can't do it anymore. There's no more room in the truck. So what do they have to do? They've got to buy a whole new truck. They've got to buy hire a whole new team of delivery people. And then they're stuck again with 61 deliveries and 120 opportunities. Right? And if they get any bigger than that, then they probably need to start operating as a grocery store, which means they need to start getting their own produce, storing it perhaps on their own website so that they don't have to send shoppers to these grocery stores to buy people's orders and things like that. Right? And that's just for one city. Imagine the capital investment that goes like, let's say they started in San Francisco and it just took off. And they had, hundreds or thousands of customers in San Francisco, and they built out this whole huge infrastructure, and they were making money and they were doing really well. And then they decide, hey, you know what? We also want to sell. We also want to open up in Los Angeles, right? Now Los Angeles is 6-7 hours away from San Francisco, so none of that infrastructure that they have in place is worth anything for selling or delivering groceries in Los Angeles. They have to start all over again. They have to get new trucks, new warehouses, hire new employees, right? Every time they move, every time they expand, every time they want to add new customers, they have a massive investment in capital. So this is what we call capital intensity. The capital intensity of a business like this is extremely high, and that makes it extremely costly, right? Now, contrast that with a company like eBay, right? eBay starts in a garage in Palo Alto just the same way, but how do they start? They start with a big rack of servers, and they start a website, and it just says, click here if you want to sell your product, click here if you want to look through all the products for sale. And they facilitate all of that. They provide a portal where you can pay, they transfer the money to the seller, they provide the address to the buyer, or the address to the seller to ship it to the buyer, but they don't actually do any of that, right? They don't hold the product and then ship it for you. They don't make sure that the person who's selling the product is actually delivering what you want. And that becomes an issue for eBay later on. And so they do institute some of these changes. But early on, they basically had a website. And the only limitation to that, to their scalability, to the number of customers and sellers they could have, was their server space. So if they built their original server that could handle 100,000 customers and sellers, well, then adding one more seller didn't cost them a dime. In fact, it was better, right? They split the cost of all of that equipment across the number of transactions. So if they had 100,000, if they added 100,000 people in a week, didn't cost them a thing. And if they added 100,001, the cost of adding an additional server is actually pretty minimal. So they have one of the most scalable types of business, which is that they simply need to have the server space and the bandwidth to handle to handle the traffic, but the transactions and the shipping and all that is actually done by the people who are participating in the marketplace. And so eBay escapes this huge investment in capital, and because of that, their returns are really high, right? Webvan was making a small fraction in terms of profit because their costs are so high. So the ability to get return on invested capital is small. But eBay has tiny costs, and then they were making huge profits because of the opposite. Their costs were so low that adding more customers and getting bigger and bigger was just generating more and more money for them without generating any additional cost. Right? So that's what this. So that's what the first thing is. What we want when we want to look at return, how it generates value. The first thing we want to think about is what's the mechanism for how return generates value, and this is just one of the strategies for that.